For my third guest on Monetary Matters, I am joined by a volatility specialist. Kris Sidial is the co-chief investment officer of the Ambrus Group, a fund investing primarily in volatility products. So that's volatility arbitrage as well as tail risk. Kris really knows what he's talking about, and it matters a lot to the stock market. I want to know, how has the volatility market been trading based on the bull market in stocks that everyone listening has been experiencing and studying? And also, how has perhaps the volatility markets been influencing the stock market? Is the tail wagging the dog? We're going to get into it all. Welcome to Monetary Matters.
The ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
Thank you. Just close the door.
Kris, great to see you. How are you doing?
Good, man. Good. It's I feel like it's been a while since we chatted in like a media type of thing.
It has. How has the summer been for volatility markets? I imagine you've been focusing a lot on the sell-off in early August. What have been the big themes?
Yeah, I mean, this past August was like a game changer in the volatility market. Over the last, let's call it 3 to 4 years, you really have not had a move like that. And I think that it was really pent up for quite a while. I remember in like January we were talking, or January of this earlier past year, we were talking about this in our investor letter, how the short volatility trade has really increased in size. You really started to see a lot of uh, QIS programs embody like more short vol programs. RIA community just really embraced the income generating side of short volatility programs, and then just naturally just a lot of like short vol hedge funds getting more inflows in AUM terms, right? Because over the last few years, those short volatility programs have done really, really well. So just a constant inflow. And in August, we saw what's pretty hard to believe, like a just a small piece of the deleveraging that transpired there, right? So everybody got quite worked up about the whole yen trade, and then we saw VIX and VIX futures make a substantial move over a 3-day period. Um, so yeah, I mean, that was one of the largest moves that we've seen in terms of just the relationship between S&P and VIX basis. And super coincidental, I had tweeted this out, like, because we wrote a paper on it in 2022 about how during the next vol blowout, you'll see this really, really increasing basis, right? So just for the viewers, so they understand what that means, like let's say the S&P, if it drops 1% in a day, historically, you see VIX move up 2 vol points. Our thesis was that when you see the S&P drop 1% going forward, you could see something along the lines of like VIX moving up 5 or 10 vol points. And it was something pretty extreme like that we saw, right? VIX futures got into the high 30s when VIX, the actual calc repriced, it repriced into the 40s. So yeah, I mean, I think that it was very fascinating to watch that quick unraveling. But I think the more fascinating thing was really how the short volatility trade really didn't get taken out. That was like really, really interesting, because what ended up happening was the VIX calc started going off of, and I know this is like super nerdy and niche, but I think listeners would appreciate it. If you look at a Bloomberg chart and you look at the VIX ticker, you'll see that it says VIX got into the 60s, but actually that's really not true, right? Because how VIX is calculated is off of a 15-second rolling period off of the bid-ask spread between these XPX options. And as the SPX options were trading in the overnight session, now they're 24/7 at some brokers, there was no liquidity there. So what you had was this like mechanical repricing of the index that was sort of like a false pricing. All right. So what people started to see was VIX futures started getting into the 30s, and then VIX, as it was repricing, got into the high 30s, 40s, 50s, 60s, right? But then like the futures weren't going with it. And that was just because of that mechanical repricing error. But getting back to like the short vol thing, why it's so fascinating is because a lot of the prime brokers, when they were calculating the margin requirements, they calced it off of a VIX 60 something, right? So when the margin recs got pushed out in the morning time, as VIX pretty much recalc to the normal calc, which is around the 40s, people really didn't need to meet the margin requirements by 12 p.m. And everybody kind of looked around and we're like, well, we're down on these trades. Like, should we cut them here? Should we not? And volatility just kept going lower and lower and lower. So it was almost like the perfect storm for short volatility to survive. And then in the coming days, you started seeing more and more short vol exposure start pushing its way back in, which is why VIX futures started really caving out. And within a 7-day period, I think VIX got from, again, like the real calc in the 40s to about the 14s. So pretty fascinating environment for two-way vol action there.
And so you think the short volatility trade is still on? There's that chart we talked about where the AUM of exchange traded funds that are short volatility had actually went up after the crisis. So people said, "Oh, the VIX went up. With a VIX at 60, that's an even better opportunity to short volatility because we know how well that performs." How are you pricing against? I mean, because we talked about on our previous show for guidance, you and me, you thought that there was a chance of a volatility unwind, the short volatility unwinding of these positions. We had that on August 5th. How are you sort of assessing the odds of that going forward? And how is that compared over history? How fragile do you think the market is right now, both the underlying S&P as well as the volatility markets?
Uh, the volatility markets, I think, are like very, very fragile in terms that any type of like severe macro shock could get vol offsides really fast. So it doesn't necessarily need to be about dollar yen. I think that you could get another event along something along the lines of that where positioning just becomes so one-sided and you'll get this like quick vol move. So I think vol markets are very fragile. Doesn't necessarily mean that I think that you're going to get a blow up in the next few weeks, right? It's like that fragility could go on for extended periods of time. However, I do think you could get these mini vol spikes along the way just by the nature of just how one-sided some of that positioning remains, right? And like I said, people could go through the data and see this stuff for themselves. In terms of S&P, I wouldn't really say that I think the S&P is like mega fragile right now because I think that the RIA community still has not rebalanced a lot of their portfolios for a lot of their clients to match the new view of an easing cycle. So what I mean by that is think about the private wealth client that has like $20 million to their name. Um, I don't think their portfolio has shifted much in the last like few months. Like I think it's more so been like systematic programs buying, CTA programs and stuff like that, making their way back into equities. But I think that a lot of that RA flow still has not made its way into market. So I think you're going to get in Q4 those RAs picking up the phone saying like, hey, look, the Fed cut 50 basis points. Like we saw how this went 10 years ago. We saw what this easing cycle did. Let's not miss out. Let's put some capital to work in here, here, and here, right? And on an aggregate level, that's a lot of flow that could come in. So I think equities could be quite supportive for, let's call it, another quarter or so, like just on some of that rebalancing flow going into Q4. But that also doesn't necessarily mean that vol can't go up, and like I think it was like 97, 98, 99, you had scenarios where S&P was raging higher and like VIX was repricing higher as well, like just the pricing itself. So people forget that, and I say this a lot on Twitter, so if you follow me on Twitter, I apologize for annoying you with this, but like upside vol is still vol. Like if the S&P moves up 3% in a day, like don't expect VIX to go straight into the dirt. People will start repricing realized volatility, right? At that point, that 3% change will be repriced into realized volatility, which then gets factored into how implied volatility trades. Just generally speaking from the market, right? Market makers are smart. They're not going to have implied vol trading, implying a 2% move and the S&P is moving up 4% every day, right? People catch on to that sort of stuff really fast. So I would say that you could see scenarios where like S&P is going up and vol is going up higher, but Generally speaking, I think that S&P will be quite supportive for the next like quarter or so, but I am expecting like a healthy unwind of that short vol trade. Like August 5th, it didn't happen, and you could look at the tear sheet of some of these like short vol firms. I think only a couple, like 2 or 3 got taken out, which was in notional terms not even a lot of money. Um, but there are a lot of programs that survived and had more AUM inflow. So I think that a healthy washout of that is coming. Have no idea when, but I do think that uh, it's more than likely next year that you'll see something like that.
So you're actually broadly supportive of the stock market. Not that it's your job to have a view on the stock market. You're a volatility trader because of Federal Reserve cutting rates 2 days ago. It cut 50 basis points. Yeah, I mean, if the dot plot of the maximum unemployment rate is 4.4%, that's where it peaks out, and the Federal Reserve cuts interest rates. Yeah, that is a soft landing, folks. We'll see. We'll see if we get it. I hope we do. But you're saying in the volatility world, which is your niche, your specialty, people who are short volatility, betting that things will be calm, and people who lose a lot of money when things get violent and turbulent, that you think there will be an unwind. What's the difference, Kris, between a little unwind like you had August 5th and something that's systemic where an unwind continues and continues until there's no short volatility investors left?
Well, I think the difference is exactly like what we saw happen on August 5th, right? So here's a good like litmus test for this. After March of 2020, you could not get an allocator to pick up the phone if you were a short vol fund. You could not, even if you survived, they didn't want to hear it. Nobody wanted to talk about short vol. Like
And that was probably the best time to do short vol.
there you go, right? There you go. Because it ended up being like one of the most fantastic stretches for short vol. Now, you had a couple of blips like June 2020, you had some blip, like Sep Oct, you had some blip in the whole
I remember VIX went
SoftBank thing.
up as the market went up, as you said, and that's when the old saying of when the VIX goes up, when the S&P goes up, it's bearish. Which I don't know if that's true or not, but people said it.
I've heard that as well. I have a different take on that, but neither here nor there. Like the main point is that um cyclically this is how sectors and strategies work, right? Like you go through these market cycles where these things get washed out. And you see it on like the long volatility side as well, right? Like post 2020, everybody wanted to talk about long vol. Everybody loved long vol like post that March 2020 and hated short vol. They didn't want to touch it. Like nobody wanted to hear about it. Similar sort of situation we're in now, right? Where like not too many people care about long vol, not too many people care about tail risk hedging. It's almost like this is silly. Um, Give me the returns that some of these short vol funds are putting up like 25-30%, right? Like fantastic returns over the last few years. So forget volatility trading. Let's just talk about markets in general. When you have that type of like one-sidedness and that disparity, it's very common that those strategies get washed out, right? Because it's a healthy cycle that takes place, right? It's just the same way that like, hey, um, I don't know, investing in like s- like uh tech names or something versus like investing in value names. Like there's times where value names are going to outperform tech names. There's times where tech names are going to outperform value names, right? There's times where you get the washout. There's times where you don't get the washout. I remember in 2022, a lot of people were like, "Hey, look, Warren Buffett's portfolio is now outperforming all the Kathy Wood stuff," right? And then like you get the flip of that. So what I'm saying is that the way how markets work, they're fluent, right? And you get these cyclical washouts. Right now, we're at the point where short vol seems to be nearing that cyclical washout where you've had this multi-year run, this multi-year performance. Everybody loves it. It can't do any wrong. Like people survived August 5th, right? It's like short vol never loses. And then you run into the final washout where people just get absolutely obliterated, like short vol funds blow up, right? So think about like the Malachites, the Ronins of the world, which for what it's worth, like I'm a bit biased because I know some folks at both of those firms, and I think they're good guys. Both of those firms had good traders, but ultimately, they still went under. Um, you'll get that again. People will absolutely hate short vol, and then we'll do the cycle all over again. So right now, I think we're at that point where just short volatility is getting ready to have its graveyard day.
Definitely a fascinating environment, even for a outward observer like myself, and definitely many in the audience. I'm sure fascinating. It's like the Super Bowl for volatility nerds and specialists like such as yourself. Just explain a few things for the audience. So volatility is just how much things move. There's realized volatility. How much did it actually move? Implied volatility. How much is being priced into how much it will move, the market's quote unquote expectation, even though that, about how much it will move based on the options price. And so you are in the oil world, let's say, I think a lot of the volatility, very high volatility, the moves happen. It gaps up from 80 to 85 to 85 to 90, such as happened in, early 2022. In equities, almost all the time, it's my understanding, the big moves happen to the downside. The bull market that we've been experiencing since late 2022, stocks have just been inching higher every day, and the move has been enormous on a monthly and yearly basis. But every day they just inch higher. When there's a crash, that's when things move down really, really quickly. And so when people talk about short volatility trading for equities, most of the time, and I don't want to say all the time, they benefit as the stock market goes higher, because as when the stock market goes higher, realized volatility comes down and implied volatility goes down. I'm sure there's the 5 to 10% cases that are exceptions that Kris is thinking about now, but generally that is true. And then people who are long volatility generally are hurt as the market goes higher, because they may own some put options, and so their delta, the right to sell the stock is worth less as the underlying goes up, and then the realized volatility, implied volatility falls as well. So generally, long volatility funds, I don't think have been performing that well this year, and that's why, Kris, I am aware of your performance year to date and performance in August. So I am impressed, and I just want to say congratulations on the great year, on the great month, as well as you also were nominated for Volatility Fund of the Year. So that is very, very impressive, and congratulations on that. Now that I've explained the terms for the audience, so the short volatility trade is something that benefits as the market goes higher. And starting from April 2020, when the VIX was incredibly high, which is a measure of implied volatility for the S&P 500, shorting volatility has overall been quite a profitable trade. Even during the bear market of 2022, long volatility, I should say long Vega products, did not perform that well, is my understanding. So short volatility has been a massive trade. I want to know, do you think that has the short volatility trade gotten out of control? And is there a market risk of that when the market sells off, people who are short volatility get totally screwed, and then they have to delever, and then that drives, basically they have to either buy put options into a falling market. They basically have to sell risk into a falling market, which of course is the nature of a market crash, of a market panic. And then very interestingly, you can tell me the exact day, I forget, August 5th or August 6th, the Friday before, very weak jobs number come out. So US interest rates, dollar interest rates fall. Also, the Bank of Japan raises interest rates. So that basically weakens the dollar tremendously against the yen, which was another crowded trade. The Nikkei, Japanese stock market, falls out of bed. The US stock market falls out of bed. So a common explanation, Kris, is that it was the primary driver of the sell-off was the unwinding of the yen carry trade. I saw a very interesting chart posted by Jens Nordvig. He's been a great guest on Forward Guidance, my previous podcast, and I'd love to speak to him again. I'll just explain the chart for you, Kris, and for our viewers, of showing the move in implied volatility on, number one, dollar yen, which obviously implied volatility went up as you had this huge move. But number two, the huge move in the VIX. And it obviously comparing two different volatility charts can be very difficult. But according to this chart, it showed that the real, wild out of standard deviation move was not in dollar yen volatility, but in the VIX. As a volatility specialist, do you think that is roughly accurate? And do you think that a big driver of the sell-off, maybe not what lit the match, but a lot of the kindling for the sell-off on August 5th or August 6th was the unwinding of the short volatility trade?
Yeah. So first and foremost, thanks so much for the kind words on the Vol Fund of the Year thing. That means a lot to us and our investors, and it's been quite a good ride. But yeah, in terms of what you were saying, just generically speaking about short volatility, do we think that that trade has gone away? No, not at all. And I think that the more and more data that we're collecting over the next few weeks coming, and then over the last, let's call it 6 weeks, is sort of affirming that. So, like, if you take a look at these short volatility programs, you'll realize that a lot of them were down, let's say 30, 40, we see like 50% mark to market during that period in August. But then when you look at the actual losses that were suffered, it was down about like 7, 8%, right? Which is survivable for a lot of these programs. Um, so I think that it's very obvious that that trade did not capitulate and did not get wiped out. And I think there are a couple of metrics that you could use to like track this, right? So one thing that we like looking at is notional short Vega across the entire street, and then again tracking the AUM inflows from some of these QIS programs or these income generating
And sorry, Chris,
programs.
what does QIS stand for?
Yeah, quantitative investment solutions. So you'll see like at one of these larger banks, you have like a tier one bank that would have a solution where they'll say, hey, do you want a target return of 13% a year? Here's how we could do this. We could sell a strip of 1 week SPX options, a strip of 2 week SPX options, three, four, like 1 month, right? And what that does is it changes the path dependency for vol selling as opposed to think back in the 90s where you just had quarterly expiration, you were subject to one path, right? So it diversifies your way of generating this yield. But unfortunately, that when vol goes up and correlations go to one, everything that short vol ends up losing, right? So all those positions end up taking large losses at once. But anyways, neither here nor there. Yeah, I think it's very obvious that that trade has not blown out quite yet. And I think also for the more so retail participants that don't have access to some of the stuff on the hedge fund side, one thing you could just look at are like the AUM inflows from some of these short vol
Mhm.
ETFs, right? So you think about the ETFs like SVXY and SFIX. So something like SFIX that sells the two front month fixed futures, the price of it got cut in half, but yet the AUM doubled, right? So what effectively does that tell you, right? If the price of that asset gets cut in half and the AUM effectively doubles, it's because more people were piling in to buy those. So it gives you a little flavor in terms of like how the retail community has been, trading short vol as well. Now, to go forward and answer your question on just everything that transpired with the yen and the VIX, yeah, totally. I would say that the biggest thing was this abnormal performance uh, that we noticed from the VIX, and I think it's really important for listeners to understand that that ecosystem is still evolving. As you include zero DT, as you include weekly options, monthly options, that the vol ecosystem is evolving and changing. So I'm more so of the view that what we have seen in that market historically in like the 90s and the 2000s, we can see more extreme versions of those in both directions, right? So like you think about a year like 2022 where yeah, stocks went down, but vol got absolutely obliterated, and that was a shocker to some people to look at that because like, how is it that the S&P is going down, but like volatility is also going down, and it's part of that evolving ecosystem where people are deleveraging their equity exposure, and simultaneously the income generating programs are taking advantage of selling vol. So it's definitely fair to say that it was a outsized move in VIX. I think that that was like, if you look at how credit spreads traded, they didn't really do anything. Like the most of the world was very dormant from a vol perspective, right? Strictly talking from a vol perspective, in relation to that. So yeah, I would say that it was definitely a VIX move, but you also have to think about the relationship that trading something like dollar yen or just like interest rate vol has because or has in relation to equities or how the participants look to trade those things. And here's what I mean. If you are a huge like sovereign fund out in Asia or something like that, right? um, what could end up happening is that you become so big into a market, it becomes very difficult to get out, right? And I know a lot of people who watch the show are market enthusiasts, so they've probably seen the movie Margin Call,
Mm.
and there's that scene where right he's sitting there and he's like, the key in this business is like you have to be first, and like that's not like a just like a made up thing, right? The movie kind of got that because like that's really how it works when you become so big in a space, like you have to end up being first, and when you're trying to be first, you can't move the money fast enough in other areas, which causes you to try to be more creative with these hedges, right? So if you think about like dollar yen, you had a lot of very large participants that were off sides. And in the VIX market, the first thing that you started to see was these larger footprints coming in to pile in and buy VIX calls and VIX futures, right? And that was like abnormal footprints that were coming in. Like locals in the space could tell you that that flow was a bit weird. Like I remember uh that Friday, I had a meeting with an investor and a friend, and I was headed on the train, and like the other partners at Ambrus were trading, and they're calling me, and they're like, "Hey, you got to come back." And like I'm calling, I'm calling our investor, and and I'm like, "Hey, man, I'm not too sure he's a trader as well." I'm like, "Hey, man, I'm not too sure if I can make it down there." He's like, "Yeah, this is crazy." So I have to hop off the train and then go back, but in that moment, I had like a lot of brokers that were like pinging me on Bloomberg chat, like through my phone, and they were like, "Hey, yeah, this is like not sure where this flow is coming from," and that's very sensible to tell you that that type of like I'm going to call it artificial flow is indicative that something is wrong. And you're having people who are losing on one side of the trade and are just trying to pile money in other areas that could potentially um, protect those losses, right? So it's probably not necessarily true that if you look on like let's say a 10-year rolling period, that VIX is correlated to dollar yen. But during these extreme moments where things start becoming off sides and that domino effect is happening and people are losing money, again, correlations go to one. So people are just like, screw it. I'm trying to buy VIX calls because I don't know what's going to happen. And I just need to be, protecting the overall fund or, wealth program or something like that. So uh, holistically, yeah, it was outsized VIX move, but I think it was outsized just because people were so off sides on that dollar yen trade.
Right. So that dollar yen traded, it was unwinding before, but that Bank of Japan meeting and the non-farm payroll that Friday, you're getting pinged. That was August 2nd, and then the real sell-off was August 5th. So what? So people, institutional investors were getting totally destroyed. They were getting annihilated on their uh, dollar yen positions. They were basically long the dollar against the yen, and when the yen strengthened, they reached for safety by buying volatility products that benefited from a market crash, such as the one that we had on Monday, August 5th. What are those volatility products of choice? You mentioned you could buy VIX futures, you could buy calls on those VIX futures, you could buy S&P 500 puts, or some combination of them. What is kind of the trade of choice to express a protecting for a market crash trade?
Yeah, unfortunately, there's no direct answer to that because of just the fact that each of those derivatives carry a path dependency, right? So when you think about this in general, you have S&P and you have S&P vol, right? And that's just buying S&P puts, generally speaking. Then you have variance, which is vol squared, right? So like think of volatility on steroids, which is effectively VIX, right? VIX is variance, and then you could have vol of vol on that variance, which is like VIX futures, right? Or options, that are linked to the futures directly. So each one of these have like different paths, right? You think about an environment like Q4 2018. Let's think of Q4 2018, where a lot of people don't really remember this Q4. The Fed, Powell at that time was changing interest rates or signal that they were going to change interest rates, and the S&P dropped 20 something percent. If you look at just generically buying like a 10 delta VIX call that month, it didn't do well. But if you think about buying S&P puts, the delta from the S&P puts paid out phenomenally well.
So Gamma performed well, Vega did not.
Yeah, yeah, that's a good way to put it. Yep, gamma and short deltas perform well. But if you think about similar in that year, if you think about February 2018, like Q1 2018, everybody knows that was Volmageddon. And what ended up happening was the flip, right? The flip of that. So S&P downside, so like S&P downside delta and gamma really didn't perform amazing, but like variance just outright buying VIX calls performed like tremendously well. So like I think there really is no like perfect answer to this, but when investors or potential investors ask us if we're in like a meeting or something, they'll say, "Well, how do you guys think about this?" The way how I like to think about it is, the like strategically putting together a portfolio that has exposure to each of those, right? So you want exposure to variance just in case you get a month like August, right, where volatility goes haywire. You have exposure to vol squared, right? This tremendous outperformance. Then you have just S&P downside puts because you just want to cut off the basis risk. So you kind of hedge off, uh, the unlikelihood of S&P going lower and VIX not performing, right? You just want to make sure you have those events like Q4 of 2018 covered. And then the final thing is really buying low vol, like super low vol, like things that people just completely don't think will occur. We're talking about things trading like, let's say 3 months out at like a 8 vol, right? Just like
Like
the most.
stocks that don't move at all, like Coca-Cola, that
Yeah, yeah,
Walmart.
exactly,
Yeah.
exactly. All right, and people will say, why would you buy vol and those type of things? And it's really because of a misunderstanding they have of this repricing of risk that occurs, right? Because if you buy like something trading at like a 8 vol for in premium terms, let's say 2 cents, and then it reprices to a 30 vol and that option goes to $1, made 50 times your return, right? So even if you put, like, do the math on that, right? Even if you put like 50 basis points of a portfolio and something like that, the return for the overall portfolio is still astronomical, right? So when you have those three pillars, right? Exposure to variance, exposure to downside S&P, and then exposure to really cheap vol, because when correlations go to 1 and that vol reprices, those could pay out tremendously. All three of those sleeves come back into one, which I like to think of as a purer hedge than as opposed to just saying rely on VIX calls or rely on S&P puts.
And on August 5th, the day of the sell-off, I know something like 480, 90 stocks were down on the day, but was it led by the big ones, Nvidia, Apple, Microsoft? I know those sold off, a lot, but did the safety stocks that were selling the day before or a week before for an implied vol of 10, did they sell off too or not so much?
No, no. So if you go back and you look at the data, it's nothing like what we witnessed in an environment like 2020. If you didn't have direct exposure to just S&P puts or yeah, of course some tech stuff as well, like the Nvidias and SMCIs and stuff like that. But if you didn't have exposure to just S&P and then VIX variance, like you probably wasn't going to do well. Those are really the only two spots that really perform well. So if you think about like and then obviously just like interest rate vol, that type of stuff perform well. But if you were just making some type of obscure bet on like utilities, right? You're like, oh, utilities are trading at like a 9 vol, I'll inventory that. Well, I don't think utilities vol move that much to make a difference. So it is just more affirmation that like this was a VIX event type of thing, right? Outside of the interest rate stuff, it was like you saw just how extreme VIX could get. And I think that's really important because as I mentioned about us writing in that paper in 2022, like the title of the paper was, is the VIX becoming more leptokurtic? And really our view was that, are you going to see more extreme downside moves in the VIX where like, the S&P is going down and VIX is just like at 12, and simultaneously you could see really extreme moves to the upside where like the S&P is down like 3% and VIX is at like 50 for some reason, right? I think people finally got to see like a little glimpse of that to realize like, okay, these guys are not crazy. They're not just pulling this stuff out of their, out of their behind. So that was pretty cool too. But holistically speaking, it was a VIX move. Like this was a vol move.
Kris, I'm glad you mentioned the name of that paper. I actually did read it, and we will include a link to that in the description. So when you said the utilities are trading cheap at a vol of 9, let's just pretend you said 8 because it makes the math easier. You mean the volatility was trading at implied volatility of 8. That's cheap. I believe an 8 volatility means that it's pricing in an implied move of 0.5%, 50 basis points every day, and that it wasn't basically, if you bought that, it's not like the volatility doubled to 16 or even to 12 and you made money on that. There was not a panic across all stocks and across all implied volatility on stocks, such as the one in March 2020. But you're just saying broad strokes, often buying the super cheap vol is a good way to hedge for that correlation go to one move. So what happened with the VIX before the day? Because I remember waking up and I saw that the VIX was trading in the 60s before the market. I didn't even know that the VIX really could price before the market. And what you said in the beginning is relevant to this. And was it a true print on the VIX? Like, could you buy VIX futures or S&P options that ever reflected a S&P of a VIX of 64 or 65 or wherever it was?
Not really. Yeah. So I just want to repeat what I said at the beginning. So when you think about VIX in the 60s, like that wasn't like the real pricing. And as I mentioned, it's calculated off of a 15-second rolling cycle between bid-ask spreads off of the strip of SPX options. So it's a weighted 30-day strip of SPX options. And that gives you the calc of like VIX directly. So if you think about what this means in the overnight session, well, SPX options are now traded 24/7, but they're illiquid, right? Because like, is there a large, retirement program that has overnight traders? Like, it's kind of unlikely, right? To trade their vol. So like one like 1/100th of the world is like up trading those SPX options at the time. So because they're so illiquid, but the calc is still continuously running, that's what people were seeing, right? They're seeing this like mechanical incorrect repricing. But that's why I said the futures found a ceiling in the high 30s. So what ended up happening was let's think about like this is VIX and these are the futures, right? So as VIX started moving into backwardation, this is what happened. They were both going up, and then the futures got to a point where they found a ceiling, and then VIX just kept doing this, right? But this all of this was just the mechanical error, right? Like the error. If you wanted to actually trade VIX at those prices, you could really just get it like the high 30s with VIX futures. But you could try to replicate a strip throughout like the SPX options, right? So because VIX is calced off the SPX options, you could say, well, can't I just buy and sell the strip of SPX options? Theoretically, you could, but the liquidity was not there. Maybe if you were, like a retail investor and you had like $500,000 in an account, sure, maybe you could get the right liquidity for something like that. But if you were like an institution or even like a smaller hedge fund, the liquidity to say, okay, boom, I could get VIX at 65, it just wasn't there. And things became even more wackier during the first opening print because there was a data dissemination issue going on with the SIBO, and spreads started going mega wide. So like for
On
I could just
options.
on options, yeah, on VIX options and SPX options. And like for us, we're looking at these and we're executing electronically, but we're plugged in with a lot of like the pit guys and the agency guys. So we're like calling dudes down at the pit. We're like, hey, can you work this order? And they're like, no, like we're zero bid, zero offer out here. And I'm like, how man? And for like a good, let's call it 20 minutes, like that was really the case, right? So for us, I'm just going to speak for us, like we were thinking about like delta hedging those exposures, right, as opposed to getting off the options. And then when that option market became more liquid, you could flip, right, where you get off all the delta stuff and then you sell off the options. But yeah, it was quite a fascinating time period because there were so many discrepancies, so many moving points that were going on at that time. But generally speaking, like you couldn't trade the VIX really didn't get into the 60s. Like the more accurate representation is like the mid to low 40s was a realistic print.
Right. And when you say you're looking to delta hedge, basically, I think you meant you had a lot of long volatility products that would have performed extremely well if you could get volatility at 65, but it wasn't actually trading there. So you wanted to basically sell the S&P, sell stocks to hedge that. Excuse me, actually buy stocks. I mean, to lock in those gains. When you say the VIX is in backwardation, that just means on a futures curve, the nearer term futures are higher. That's why they spiked up. And the bid ask spread, I think you meant on the options, is like if if an S&P option, SPX option, I should say, was, let's say, price selling, normally at say $30.00 bid, $30.30 ask. The bid went from $30, basically the ask, people who were selling options, they got so scared that it went from like $30 bid to, or let's just say it went to $60 bid to $160 ask. And so then the quote unquote midpoint between 60 and 160 is 110, but that doesn't mean that the 110 option is pricing in a variance or VIX of 65, but that doesn't mean that it's a real price. Like, I'm sure this happens to you literally every day, but the handful of times I've dealt in the illiquid options market, it's like it's bid five pennies and ask $5, and the midpoint is somewhere in between. And if you own an illiquid option, sometimes your broker will mark you, and you made or lost a lot of money on something that doesn't really exist or even matter. So is that what you kind of referring to?
Yeah, something like that. So yeah, you're certainly right that um like that midpoint is incorrect, and that was sort of giving that false calc to VIX. But just facilitating and buying and selling those options, you know, um if you go out into the open market on like some illiquid tails and you bid up, eventually somebody's going to come in and hit that. But this was a point where like that data wasn't feeding through correctly. So a lot of market makers are sort of looking around at one another and they're like, yeah, not sure where the pricing should be right now. And because that data dissemination was making it so much worse, you had a lot of people that were just like, we're no bid, we're no offer, and like, we're just gonna pause. So if you like go on Bloomberg or something like that and you pull up a chart of the VIX intraday, what you'll see is that it looks super weird and like choppy, right? You'll see like, print here, print here, print here, print here, and then it starts like smoothing out. And that's just because of that data dissemination issue that went on. So, but yeah, like overall, you're spot on with that.
Got it. And I think a key assumption in mathematical modeling of options is that not just Black Scholes pricing of options, and then you have a normal curve, fat tails. There's a reason why the tails are fat. Okay, we all get that. But literally, the fact that prices don't go from $30, when a price goes from $30 to 29 cents, sorry, $30 to $29, it doesn't have to stop at 29.50 along the way. It can just go there. It can just gap, right?
Yeah, absolutely. So, over the last let's call it 2 decades, you've had a lot of people put out work on just like vol surfaces and vol pricing models. And like my old boss used to say this, like very, very simple. He'd just be like, I don't care what the model says. Where's the market looking to trade at? That's the value of the option. And like you see a lot of people on Twitter talk about like second order derivatives and Greeks and stuff. And I think that for the average person, it's like not needed. Like if you're running a complex derivatives book and the S&P goes down 3% out of nowhere, you know, you do need to understand like those second order effects. You're thinking like, okay, where's my Vanna exposure, right? Like what's vol doing? Because those are shifting your book around so crazy. But like, if you're a retail trader that's like trading in and out of stuff, like those things really aren't important. And the obsession with those second order Greeks often leads to this secondary obsession with like option pricing models, right? You're like, oh well, my model says that this should be priced at 10 cents, right? But the market right now is trading it at like 15 cents. So I'm going to sell it. And that is a huge issue. Like that is like not how trading works at all. Unfortunately, I think a lot of people get caught up into that, and they end up losing money, and then they realize like trading is as simple as me, buying and selling this bottle of coconut water, right? Where it's just like there are times where the market's going to buy this at $5. There's time they're going to pay 20. There's time they're going to pay 50 cents. And that's at the end of the day what drives markets and prices is just supply and demand dynamics. So regardless of how you want to look at an option, and no matter how fancy your vol surface and the fitting processes and the pricing model, it's just like at the end of the day, like markets are going to trade where they want to trade these derivatives, and that's the price of the derivative.
And so what you're saying is kind of a volatility version of the market can just because the market's irrational, it can get a lot more irrational. Like maybe those quants are right that the true value of it is at 10 cents, so they sell it at 15 cents. But it could go from 15 cents to a dollar 50, or it can go to $10, and basically it doesn't matter that their model says it's underpriced or overpriced.
Yeah, exactly. I mean, there are like when you get like become a part of like these more sophisticated derivative desks, you start realizing there's a technological lift that comes along with it, right? So you have all these like fancy tools that get presented to you, but then like at the end of the day, it's just really important to take a step back and just be like, okay, well, like that pricing model only takes you so far, right? It's like going to an auction and looking at a car, right? And like you run a bunch of numbers in this calculator and you're like, okay, the car is valued at like 5,000 bucks, right? But like if there's some dude who is like buying that car for $5 million, well, like the car's gonna sell for $5 million, right? No matter what the calculator or whatever you think happens. So it's just important to always be on the trading side of these things and remove yourself from that like very dogmatic approach, right? There's like quantitative framework, but then also like the sensible framework of like that discretionary input to say like this absolutely doesn't make sense. And I think that those individuals that are able to make that sort of dislocation end up being very, very good, successful vol traders. Like a lot of the really successful vol traders that I've come across, including like some of my ex bosses, all have had that ability to just say like, I don't really care what this is saying. Like I'm seeing what the market is doing, and it's important to like separate the two.
Right. And it's saying all the people have these models. And I think that one of their inputs in their models is going to move in a certain way. And therefore, I'm going to predict that the underlying options will move in a certain way, even if I don't think that the models are right. And so to take your example, let's say the car, it's not even, you don't think it's worth $5,000. You think it's literally worthless. But there's some people, there's a large institutional investment community that thinks the car is worth $1 million, but they trade based on the lunar cycle, and it's about to go into a full moon, so you think, oh, actually they're going to bid up their intrinsic value is going to go from $1 million for the car to $5 million for a car. My somewhat stretched analogy, I'm thinking of an extremely almost near bankrupt company I saw that had warrants, and the underlying stock was trading at 50 cents. The strike price for the warrant, because the stock had done a reverse stock split so many times, was in the $2,000 thing. So it would literally have to go from 50 cents to $2,000 over however long, 3 to 4 years, however long the warrant had left. But the implied volatility was at 2,000. And as you know, in applied volatility over 3 years, that's what, like 750 trading days. You're going to get ridiculous things that the option, a warrant, the right to buy that stock that's currently trading at 50 cents with a strike price of 2,000 had some value. It was like 3 cents. So, that's company is that option has no value, of course, but it traded because, the institutional investment community, they have, instead of a lunar cycle, they have this thing called implied volatility in Black Scholes.
Yeah. I like the lunar cycle thing too because it sounds so like nonsensical at all, right? But that's just how markets are. Like I think people discount the behavioral impact that takes place in markets in general. So you could have a dude who is running, like $30 billion in this long short equity fund, and he just wakes up in a really bad mood, right? And that affects, now obviously as a professional that shouldn't affect you, but like he could just have an inclination to buy or sell a certain security, right, with a lower float, and that could really be detrimental to the price of the security. And that's just how it works, right? Because like it doesn't matter whether you believe in his process or not. It's just his mood was affected by it. He decided to buy or sell like a security, and that behavioral transition affected the price of the asset. And that's super, super important. So doesn't matter if you're flipping coins, doesn't matter if you're throwing darts. Like if you're the large player in the room and you're moving around the asset price, that's where the asset price will trade at.
Kris, would you define Ambrus, your hedge fund, as a tail risk fund or as a volatility arbitrage fund or both? And if it's both, which ones comes first?
So I would talk about Ambrus on a firm level as like a firm that specializes in tail risk hedging. And I would say that it's an expertise in volatility trading. So when we were first coming into the business like 4 years ago, the biggest thing that we wanted to bring into the business is what was really this form of trading volatility, like what you would see on the proprietary trading side. Because what you saw on the hedge fund side was like really, really, really different. Like I've actually never seen such a disparity in a sector like in my life.
Describe what you
So
mean. What disparity?
yeah, yeah, absolutely. So like I come from the world of like prop trading, right? Like my ex-boss Bob Cantor, like he ran ETG in the 2000s. I was a part of Chimera. I traded under a bunch of XG2 guys at Xanthus. Like that culturally of thinking about capacity constraint edges and extracting those edges from markets and doing it over and over and over again. Like that's what's on the prop side, right? And if you think about like I'm going to use these firms just because I have friends at these firms. We have investors that are ex-partners at these firms. Like I know these firms quite well and I know the culture, but like you think about like a firm like Peak Six, right? Chicago prop trading derivatives, extremely successful, very bright minds, like really good derivatives firm. CTC, same thing. If you go to these firms and you see the caliber of traders that come from these firms, they're really, really good. And stylistically, you may have some traders at these firms that run a book that resemble what we look to do, which is in normal markets, you trade around a lot of stuff and you either hope to be flat or make a little bit of money. But when volatility blows up, you make life-changing amounts of money. That's really the model, which I think has made both of those firms so successful. Like you think of the P&L attribution of very good derivative firms, that's what it's looked like. And on the coming from that prop side, right, you're like, oh, this is normal. Like this is how people should think about like derivatives trading. But then like on the hedge fund side, like that's actually not what really existed. Like on the hedge fund side, I think you see a lot of like long volatility or tail risk programs get a really, really bad reputation. Because I think a lot of the hedge funds that have built out these volatility products end up being more solutions orientated. So like the common theme that you'll get is this story about like the pension plan or the endowment or the foundation that's like really upset. And he's like, I'll never invest in long volatility. I'll never invest in tail risk hedging. Like I can tell you, we've had these discussions
Mhm.
with like, you know, some of those allocators because they've been so turned off throughout the years of these like these type of products that have suffered. And you think, okay, so why is it that these products have suffered? Why is it that long vol does so bad or tail risk hedging does so bad as a sector, right? And it's really because a solutions application, like what some of these funds look like is they'll buy 1 delta or 10 delta S&P puts and roll them every month, right? So what's what's just generally happening is you're betting against the market, which historically speaking, we know equities have this upward drift.
Mhm.
And then when you do that in a way that has no alpha, it's almost like a double whammy, right? You could bet with the market and have no alpha and make money, right? There's like passive
Yeah.
indexing, right? You could bet with the market, make no money. Sorry, have no alpha and still make money. you bet against the market with no alpha, it's double whammy. You're losing 2x, right? Like that's how I think about it in my brain, even though it may not be like entirely true. And most of the programs look like that. So they try to like package these like solutions or solutions based way of trading into these like vol funds. And then the pension plan or the family office or the individual investor, they look at their statement and they're like, for the last 5 years, I've lost 200 basis points each year on this thing. And when vol finally goes up, I only recovered like 25% or 50% of this. This is like, doesn't make sense. And some people
Chris, when you say I've lost 200 basis points on it or 2%, they didn't lose 2% of the fund. They lost 2% of their entire portfolio on the fund. They
correct,
lost way
correct,
more just on the dollar in the fund. And
correct.
when you said, I think that you say they have no alpha. They also short the market by just being long S&Ps, S&P put options always, and they're also short or long. I mean, you tell me the variance premium. They're long implied volatility, and implied volatility is often, over time, it's going to be higher than realized volatility. And so if they never have a view and they're not moving in and out of it, then they suffer from that one too. So it's a triple whammy, isn't it?
Right. It's just like, forget my bias towards it. Like look at the performance, right? Like you could look at the performance, or you could just or you don't even have to look directly at one fund or one like solutions product. You could just look at the back test of like buying like a 10 delta S&P put, right, and rolling it historically,
Or
or
if you
you
don't
say,
want to do
okay,
that, just look at the back test of buying front month VIX futures and rolling them. Look at UVXY.
yeah,
In
exactly.
2009, so UVXY now is $23. If you bought it, it was $88 billion in 2011. Now, of course, it was never at $88 billion. They just did so many reverse stock splits because the performance was so bad, but it's down 100% of all time. In realistic, 99.99999%. But yeah, these things do not perform well.
Yeah. So
If held to, yeah.
yeah, yeah, absolutely. So some people will say, well, Chris, that's a bit silly because the whole point of a tail risk hedge is to reduce the variance in a portfolio and enable an investor to buy discounted assets, which in turn increases the geometric return over a full market cycle.
Mm-hmm.
And what I'll say to them is that on paper, that seems true. But if you expand the horizon and you look over a wide enough time horizon, all roads will point back to the same thing. A decaying or a bleeding tail risk hedge will still cost more in the long run than experiencing the volatility of just the general S&P. So again, you guys who have that argument, test this for yourself. Go back from the 80s, start from the 80s and run a program that buys S&P puts, right? Like, and just rolls them. And you'll see that, or use 50 basis points a year, use a percent a year, it doesn't matter. You'll still see that when you have a tail risk hedge that loses too much money, it takes away from that geometric, that compounding, geometric return over the long run. So just kind of coming back, right? Just like stylistically, like that's like the way how I was taught to think about trading, derivatives and volatility was very different than like the solution side of the business. So that was our goal, was like, okay, you could bring sort of a similar model that's like what's done internally on the prop side, right? Stylistically, where you may have some traders that may say, hey, I run my book in this regard. And you could bring that to the hedge fund space and say, well, here's a hedge fund product that doesn't just lose money every single year, but then has the convexity to potentially have this really large return if volatility goes up a lot. And that's like the big differentiating factor, I think, between us from a firm level and then some of the other firms. It's just more of the focus, or like culturally embracing like the real trading side, that which you would generally see from like the derivatives prop trading community, as opposed to the hedge fund solution side.
And so, just for the audience, it seems to me like you're kind of talking again. You're rejecting the talking point about why tail risk funds, which you identify yourself as, should exist. So it's almost as if I'm talking to a macro hedge fund trader who's like, actually, macro doesn't really move that much, and central banks, the interest rates move up, currencies move up, but who cares? Like, its stocks perform better than macro. So you're differentiating yourself. Why is it that, and I'm not saying I always bought this argument or didn't buy this argument, but the argument is, even if a tail risk fund underperforms or has a negative return over time, it can still provide value because an investor in that tail risk fund, when the market crashes in March 2020, as it did, and you generate a 3 times return or a 2 times return, that investor, the cash is very valuable at that time. So they could use those cash generated to deploy it into assets at a fall in value, or just not have the stress to sell other assets. So I always, not always, but a counterpoint that I've had against that argument is just rebalancing. Like, do tail risk funds let you just take the money on March 23rd at the peak in the VIX, or is March 18th, but at the bottom in the stock market? Like, I think there is, hedge funds have a redemption period and everything. But setting that aside, assuming it was perfect rebalancing, why is it that argument is false, Kris?
Yeah, just because like what I said, right, is that if you look at the data and you go over a wider time horizon, you'll realize that a decaying tail risk hedge is going to put more pressure on the overall returns of the vehicle than the accelerating points as to you buying discounted assets, right? But ultimately, don't get me wrong, like I believe in that philosophy. It's just the extremities of the philosophy. You can't lose 20% a year in this decaying asset class, right? And say, well, it's just a function of like sizing, because ultimately you're just overfitting. You're overfitting the data, right? If you're like, well, this is a portfolio solution, we'll put it in here because when the S&P goes down 20%, we need to be fully hedged off. You're overfitting the data and you're running into a sample size dilemma, right? I mean, think about how many times VIX has went over 40 over the last 3 decades. It was 11 times. Kind of more frequent than people think, but also not statistically valid at all, right? Like you can't try to have a fitting process there. So like the way how we think about it is you need that middle ground. Don't get me wrong, like some tail hedges will bleed, but it's really about finding that middle ground balance of this bleed is unacceptable because like this is really decaying my returns versus like over the last 3 years, a fund was down 1% versus like a fund's down 30%, right? Like two are tremendously different. And that's kind of why I say like culturally on the prop trading side at like these good derivative firms, you may have some people that trade dispersion, you may have some people that trade like a short bias vol book, right? And but then you run into people that stylistically trade like a long vol bias book. And the commonality across these really good derivative decks that trade that long bias, that long vol bias book is we're going to make a little bit of money when things are normal or we're going to be flattish, but when vol goes up a lot, we're going to have life-changing returns, right? That's how those traders stylistically think of it. And like that was sort of how I was trained to think about this. And then when I, started moving into the hedge fund space, I was like, this is a good fitter for that issue that high net worth individuals have, like family offices have, foundations have, endowments have, because people are just not interested in the whole, yeah, just buy these S&P puts and just lose money every single year over year, because they realize like it's very difficult. And I kind of present this to anybody who's watching, like to get an allocator who has invested in those tail risk or long vol programs over an extended period of time and have them say something positive about it, because the space has been plagued with so many of these poor products and solutions. And hopefully people don't take offense to what I'm saying, because I think that I'm sort of speaking the truth that a lot of people know is the truth, because I'm not just being biased. You could look at the numbers, right? Like you could take a look at some of these returns historically. But why I said that there was so much disparity between this is because if you look at the top 5 performing long short traders at like a proprietary firm, and you look at the top 5 performing long short hedge funds, not much disparity. You'll see like, well, the top 5, like hedge funds in long short have very similar return to the top 5 main traders at these prop firms, right? It's like maybe sums up 40%, maybe sums up 30, whatever, right? But you're not going to see one side up 30 and the other side down 5, right? Like you really don't get that. But if you look at like the long vol or tail risk hedging space, historically speaking, you take like P&L attribution at one of these Chicago prop trading firms and you see stylistically like what those earners have put up, a long vol bias trader at one of these shops put up, and you look at the returns that one of the those other like long vol, and you'll be like, how are these two people trading the same asset class? It's sort of shocking, and it's not because like I want to be careful with my words here. It's really because the style of trading between the two are like night and day. They're both looking to accomplish the same thing, but the style of trading is very different. That solution side, and it goes back to what we were saying, that double whammy, triple whammy thing. If you're on that solution side of the business trying to orchestrate a product like that, you're running into like the triple whammy of like losing money. What I'm trying to say is that stylistically trading vol from the prop side, like at some of these firms, is very different than the solutions orientated applications of trading vol, which is just like, oh, buy a 10 delta S&P put and rebalance every month, and we're going to roll that and roll that and roll that and roll that, and then like we're going to start a fund vehicle and we're just going to keep it, raising assets in this fund vehicle. And then because what you end up getting, right, are those really unhappy like pensions and foundations and like family offices, to a point where like people get disgusted at the asset class because they're just like, this thing is just losing money every single year. Like, and when vol goes up, it's not really making a lot. And it's like, it's not really like, I wouldn't even put blame on the manager, because if the manager says this is what we're doing, like, you as the investor should be
Yep.
well educated enough to understand like this is not going to work, right? Okay, so why isn't this going to work? Because historically speaking, doing something like that really isn't going to make money. So the manager is just following the mandate that he's set out to do. I can't really fault him on that. But do I believe that stylistically that's the best way to trade vol and how people should be investing in vol? No. I think that's like a terrible I think it's a terrible idea. I think there are much, much better ways to do that, right? So, and for unfortunately, like most of those guys on the prop side just stay on the prop side because they don't need to deal with the headaches of like building out a hedge fund vehicle and like dealing with all the administrative stuff. But like for us, that's kind of where we thought that that was a really good liaison, was that we were willing to build out the infrastructure, build like put in the administrative work, deal with all the headaches, because we thought there was like a gaping hole there that stylistically this style could fit into a way better thing that people were looking for, as opposed to like what the industry was used to getting, previously.
Uh, we spoke on the phone in August, the day of the sell off, August 5th. You were very busy trading. You were like, this is the Super Bowl for me. But there was time you consider doing an interview. Ultimately, I got another great vol trader, Noel Smith. So we didn't end up doing an interview then. But I knew from our call that you thought there was a chance that volatility would continue to expand from there. And that was a different view than Noel, who thought actually volatility would go down. So, I've interviewed a lot of people and I've guessed that a lot of them are right, a lot of them are wrong. What really impresses me is someone who can be wrong and make money, because that shows that you're a trader. So tell me about your view that, actually there's a decent chance this VIX thing, the short vol trade isn't going over. But at some point you must have realized, okay, vol is going to continue to compress, and I've got to trade based on what's in front of me. So tell me about your experience from midday August 5th until now.
Yeah. So first and foremost, like I know Noel, and shout out to Noel, because we're talking about that like prop trading style versus like the solution side. Like Noel also comes from the prop trading derivative side, right? So like him and I could sit there and talk about risk, and we could talk about like trading philosophy, and we could have a very active conversation where both sides are feeding into the conversation in a progressive way. But like you could sit down and have that discussion at like one of these larger pensions, and you speak with an analyst there, and they're like, well, we think that the tails are undervalued or overvalued, and you're like, well, I could clearly tell this person didn't really come from like a trading background. So like Noel's very, very, he's like the perfect person to like make that link based on what we were just talking
Yeah,
about
but you're
before.
saying that someone who would make a comment about the tails being underpriced or overpriced, automatically that comment shows you that they don't really come from a prop background.
Correct. Right. Like there's like things like that I think that you like You ever heard the expression, a fisherman sees another fisherman from afar?
Yes.
Okay, so it's sort of like that, where if you get two traders in the room, they'll be able to jive with each other, and even if they're trading completely different asset classes, there's just like a style of thinking about this in a very different manner. So yeah, Noel's like a great person, just based on we were talking about good traders coming from like the Chicago prop style, very similar. Okay, so now like moving forward, onto that discussion, I would say that that is the biggest thing that differentiates like good fund managers, good managers, good like traders in general, is this ability to disassociate themselves with their view. I cannot stress this enough. I'm wrong every single day, like 6 times, 7 times a day. I'm wrong every single day. So internally as a team, right, we're chatting all day long, myself and the other guys part of Ambrus, and like we'll make just calls all day long, like, oh, I think S&P is going up, I think VIX is going down, I think Qs are going to stay sideways. Like we're making all these like obscure calls, but it has nothing to do with like how we trade, right? That has nothing to do with like how we trade at all. And like philosophically, this is how I think you get like a good trading framework. I think you spend the time um looking at markets for a very, very long time and understanding certain capacity constrained edges that exist out there. And then you spend the time building out a quantitative framework to affirm that view, right? So if you're like, hey, every day at 9:45 I see some guy coming in to sell 25 delta VIX calls, right? Can you statistically affirm that over a long time horizon, right? Not just like a 2-year horizon. And if you have something that has this like durable edge, then you could start building out a risk framework around it. Now you could say, okay, how do we optimize around this? How do we think about the risks? What are the embedded risks that we don't understand? Like, where are we completely wrong on this? How do we track alpha decay? All these sorts of things, right? You could get more creative with the quantitative framework around this. Then you put this into production. And what the trader is there for is to monitor this to make sure that things are not going astray. And if they do start going astray, you start cutting risk very, very aggressively. So like there are certain risks that we do not tolerate. Like we don't sell tail options, we don't sell optionality. We understand where our max losses are at in every given respect of a strategy sleeve.
But you said you don't sell optionality, so you never sell an option unless it's, to you bought a call here and you sell a call, so you spread. But you said you never sell optionality.
When I say never sell optionality, I'm talking about like uncapped like losses in terms of like, oh, selling like a S&P call. Well, theoretically that could absolutely
Mhm.
obliterate you, right? There's another way to express that view. Can you sell a S&P call spread, right? Like are you
Mhm.
effectively selling optionality? Are you effectively selling convexity? No, because that's capped on the upside. So I think having that framework and that principle as a firm is like really, really important because it saves you in times where like yeah, August 5th or 6th, i I definitely thought, because historically I've seen vol moves happen, and then even after they'll have this like semi spike. It happens after every like VIX spike. You'll see like a semi spike that will end up transpiring, and like that was like embedded in my head is that like yeah, we'll get a little more of that, in the coming weeks, which we absolutely didn't. But that didn't affect the way how we traded the portfolio because we have like a quantitative framework that we need to follow around like a good way to trade. So like understanding the VIX basis, right? VIX to S&P basis was like really, really blown out. We understood that people were off sides. We saw how some of these options were repricing. All those comes, all those like let's say quadrants come into effect to make this like really, really cool matrix where you say you need to lock in 10% of what the portfolio is valued at that time, versus you saying, oh well, I think I think vol's going to 70, and I'm just going to be stubborn about it, right? Like that's
Mhm.
not how we trade at all. So I think it's really important for like managers, traders to remove their view from their trading. And I think it's like relying on a good, strong quantitative framework and then having these small discretionary tilts along the way, but not really getting into a position where they're saying, oh, like the world is collapsing. So, and personally speaking, like, I still think that we're going to get some more vol, just because I think that the embedded leverage in the short volatility trade has not blown out yet, and I'm pre- like to me personally, I think that that type of leverage needs to come out of the system. It works in both ways, where strategies get flushed out, and we've seen this over every market cycle that you could think of. It just doesn't work that way. That's like just saying stocks will only go up, forever, and there will never be a pullback. Short volatility will not always work, right? It's not that short volatility will work for 20 years without a drawdown. That's just not how markets function. So I do think that we're going to get more vol, and I kind of anticipate into next year we'll see a little bit more of that deleveraging that sets up for more opportunistic long vol. But that's not going to affect how I trade the book, right? I'm not going to sit there and put a certain amount of risk on that's above our risk limits and things like that around the framework we've built out. And I think that's just super, super important.
I'm really glad you gave a great interview that not only interesting, I learned a lot, the audience will learn a lot, but we got to keep people entertained at the end of the day. Thank you so much, Kris Sidial of the Ambrus Group. People can follow him on Twitter at KSIDIII. Thank you, Kris, for being the third guest of Monetary Matters. Thank you, everyone, for watching. Make sure to subscribe to Monetary Matters on Apple Podcasts and on Spotify. We'll get to the other platforms a little bit later. Me and my business partner, Max Weethy, and of course on YouTube, Monetary Matters with Jack Farley, and on Twitter, I am at Jack Farley96. Leave a review if you feel so inclined. It helps support the show. Thanks again, Kris, and thanks again, everyone, for watching. Until next time.